Today, we're talking about some major changes to Canada's mortgage rules. Now, these changes could be game changers for buyers in today's market.
Let's start with one of the biggest changes, which is the increase in the insured mortgage cap from $1 million up to $1.5 million. Now, this might sound like just a number to you, but it actually has a huge impact on how much you need for down payment.
That's right. So currently, if you're buying a home that's worth over $1 million, you actually have to make a 20% down payment on the full amount. That can be a pretty challenging thing to do, especially in markets like Toronto or Vancouver, where even starter homes can be priced over that $1 million mark.
Exactly, Vince. So with the cap increased to 1.5 million, buyers can have access to an insured mortgage, which means that your down payment is as low as 5% for the first $500,000, and we're assuming it's going to be 10% for the remaining million, but that hasn't been confirmed yet. The main point is the fact that you can purchase something up to $1.5 million with less than 20% down.
This means that buyers can get into more expensive properties with less cash up front, and that really opens up opportunities.
Now, if you're new to this channel, my name is George, this is Vince, and we are local real estate agents here in the Waterloo region. So if you're thinking about buying a home, selling a home, or you just have some questions about the real estate market, you can shoot us a text at the phone number on the screen, or even book a personalized one-on-one consultation with us at the link in the comments below. Another key change is the introduction of a 30-year amortization for first-time home buyers with less than 20% down. Now, earlier this year, this change was introduced for first-time home buyers looking to purchase new construction properties, and now it's going to be available for first-time home buyers that are buying resale properties as well.
Right now, to qualify for a 30-year amortization, you need to have at least a 20% down payment and avoid using mortgage insurance. Now, this really impacts and lowers the amount of people that are able to use these longer payment periods.
But under these new rules, first-time home buyers will be able to spread out their mortgage payments over 30 years while still taking advantage of the lower down payment options. But why is this helpful to first-time home buyers?
Well, when you're able to spread your payments out over a longer period of time, that results in lower monthly payments, which could make home ownership more affordable for first-time buyers or buyers with a tighter budget.
Now, some people will point out that with a 30-year mortgage, you will pay more in interest than with a 25-year mortgage, even though your monthly payments are lower.
That's right, that's 100% accurate. But even with all of that extra interest, if it helps you enter home ownership sooner rather than later, it's still a lot less expensive than if you were to rent over the same period of time.
Another big change to the mortgage rules is that you no longer have to pass a mortgage stress test when you're looking to switch lenders during your renewal period.
Currently, if you're looking to renew your mortgage and stay with the same provider, you didn't have to go through this mortgage stress test. However, if you wanted to shop around and potentially switch lenders, then you would have had to go through the mortgage stress test. What this change does is it effectively increases competition among lenders, because if you want to go to a different lender, you no longer have this extra hurdle to pass.
Right. So basically, this gives homeowners more power when they're shopping around and could lead to lower interest rates in the future. So if your mortgage is nearing the end of its term, you might be able to find better deals out there.
Now, while these mortgage rule changes bring about some exciting opportunities, they don't come without their drawbacks as well.
For one, increasing the mortgage cap could push some buyers into a higher price point. This could fuel demand and result in higher prices in certain markets.
Also, as we mentioned, that 30-year amortization, while it helps lower the monthly payments, it does cost more interest over time.
And finally, these changes don't address the root of Canada's housing crisis, which is the lack of supply.
Simply put, more homes need to be built to meet demand, and that takes time.
So, while these reforms make homeownership more accessible, they will not solve the housing crisis on their own.
Overall, this is still great news for Canadian homebuyers, as these changes make home ownership more accessible. So if you're thinking about entering the market, it could make it more possible.
Absolutely, Vince. Now let us know what you think about these new mortgage reforms. Will they make home ownership easier for you? Drop your thoughts in the comments below and make sure to subscribe to our channel for another video next week.